Is the U.S. economy already in trouble? Well, there's some headlines out there saying absolutely. But I got to tell you, the real story, it might surprise you. And I'm going to break it down in this week's Wealthologist Weekly. Hey everyone, Chris Hobart here, the Wealthologist, bringing you the real story behind the headlines so you can make smarter financial decisions. Now today, we're going to tackle a big question. Is the U.S. already in recession? Now, maybe you've seen or heard the news and the whispers, negative GDP is coming soon. But before we start stockpiling canned goods and gold bars, I want to take a step back, right? Yes, there is a good chance the economy shrank in the first quarter of 2025. But that doesn't mean we're in a recession, not necessarily at least. Let's break this down. No fluff, no jargon. I want to give you the facts that you need. So, first, why are we seeing negative GDP growth? I want to start with the basics. What the heck is GDP? GDP stands for Gross Domestic Product. Now, this is essentially the total value of all goods and services that we produce in the United States. So, if GDP shrinks, it means the economy is slowing down. So, why does Q1 look so weak? Well, there's a couple of reasons. First, consumer spending slipped. Retail sales fell 0.9% in January. And when people aren't spending as much, businesses don't make as much. I've told you before, consumer spending makes up about 70% of our economy. Number two, the housing market, it took a hit. Housing starts dropped 9.8% and existing home sales fell nearly 5%. Now, when real estate slows down, so do jobs in construction and lending, as well as home improvement. Number three, manufacturing struggled. Factory production and capital goods shipments both declined in January, which means businesses, well, they were holding back. Four, job market jitters. Unemployment claims jumped from 213,000 to 242,000, which could be an early sign that layoffs are picking up. But here's the big kicker. The import surge messed everything up. It messed up all the numbers. See, one of the big reasons for negative GDP projection, it's not actually a sign of economic weakness, technically. In fact, all that other stuff, it plays a role, but I want to educate you a little bit. You see, in January, due to the potential tariffs coming in, imports surged, especially industrial supplies. Now, the way the government calculates GDP, it's a little bit weird. When we buy stuff from overseas, it gets subtracted from our GDP. So even if we're spending money, if it's on imported goods, it actually makes our GDP look worse. Now, here's the twist. The import surge was likely driven by businesses rushing to beat potential tariffs. Now, the Trump administration has proposed lots of new tariffs, and companies, they're bringing in goods early to avoid paying higher prices later. All this means that Q1 numbers look bad now, but they could bounce back in Q2 when imports slow down. Now, does this mean a recession is coming? Not necessarily. You see, one bad quarter of GDP doesn't mean we're in a recession. A real recession means consistent economic decline. Think of job losses, lower consumer spending, like major lower consumer spending, businesses shutting down. And right now, we're seeing a mix of good and bad. For example, wages are still growing in a lot of sectors. The stock market, it's not totally panicking. We're seeing some volatility, but that's, par for the course. The Fed might adjust interest rates if things slow down a bit too much. But the risks ahead, kind of some lights we're watching as well. Government spending cuts. If Washington follows through with major spending reductions, some businesses and consumers who rely on that money, they're going to feel the squeeze. And this can lead to volatile markets. Investors, they hate uncertainty, and economic data right now is all over the place, which is why we're seeing that volatility. Inflation and interest rates, if prices stay high and borrowing remains expensive, well, growth could slow down further. Now, you're probably wondering, what should you do? What does it mean for your money? Well, a couple things. First, stay invested, but stay smart, right? Don't panic over short-term headlines. If you've got a solid long-term financial plan, stick with it, but make sure it's right for you in your current situation. Number two, I want you to watch the housing market. If you're buying or selling a home, be aware that the market is shifting a little bit, and timing matters, specifically depending on where you live. Number three, keep an eye on jobs. If we start seeing layoffs start picking up, that's oftentimes a red flag for the broader economy. So what's the bottom line? The economy, it's given us mixed signals right now. One negative GDP quarter doesn't mean we're in a full-blown recession, but we need to keep watching the data. Now, I'm going to be tracking this, my team's going to be tracking this and keeping you updated. So make sure to hit that like button, subscribe to our channel, and turn on notifications so you don't miss anything. Now, if you've got a question, drop it in the comments. And I also want to know, what's your take right now? Are we heading into a recession or just a minor blip on the radar? All right, everyone. I'm Chris Hobart, the Wealthologist. See you next week for the Wealthologist Weekly.